Let's be honest, most people think investing is only for people with a lot of money. Maybe you've looked at your bank account and thought, I'll start investing when I have $1,000. Or maybe, I'll wait until I'm making more money. The problem is that thousands of people keep waiting for the perfect time. Weeks become months. Months become years. Before they realize it, they've spent years thinking about investing without ever getting started. Here's the truth. Your first $100 probably won't make you rich, but it could become the most important money you ever invest. Not because of how much it earns, but because of what it teaches you. The hardest part of investing isn't choosing the right stock. It isn't predicting the market. The hardest part is taking the first step. Once you invest your first dollar, something changes. You stop thinking like someone who wants to invest someday. You become an investor. That shift in mindset is incredibly valuable. Think about learning to ride a bicycle. Reading about cycling doesn't teach balance. Watching videos won't stop you from falling. Eventually, you have to get on the bike. Investing works the same way. You learn the most by actually starting. Many beginners believe their first investment needs to make them rich. That's why they chase the newest cryptocurrency, the hottest stock, or the latest trend. They're chasing excitement instead of investing. Real investing is usually boring, and that's a good thing. Imagine planting a fruit tree. Would you dig it up every morning to see if it's growing? Of course not. You water it, you protect it, then you give it time. Your investments deserve the same patience. People want quick results. They want to double their money in a month. That's why many beginners lose money. They're trying to sprint through something meant to be a marathon. Here's another truth. The amount you invest matters less than the habit of investing. Imagine two people. One waits 3 years until they save $5,000. The other starts today with just $100 and keeps investing every month. Who builds better financial habits? Usually, the person who starts early, because consistency beats perfect timing. Before investing, ask yourself one important question. If your car broke down tomorrow, or you had an unexpected medical bill, would you need to sell your investment? If the answer is yes, investing may not be your first priority. That doesn't mean you're failing. It means you're building your financial house in the right order. A small emergency fund gives you peace of mind. It helps you avoid panic. It keeps you from selling investments at the worst possible time. Think of it as your financial safety net. Debt also deserves attention. High-interest credit card debt is very different from a low-interest mortgage. Paying down expensive debt often gives you a guaranteed financial benefit. Once you've built a small emergency fund and reduced costly debt, you're ready to invest. Many people overcomplicate this step. They spend weeks comparing investments, watching videos, reading articles, trying to find the perfect choice. Meanwhile, someone else opens an account, makes their first investment, and starts learning through experience. Remember this, your first investment doesn't need to be perfect. It simply needs to get you started. Investing is a lifelong habit. The sooner you build that habit, the easier every future investment becomes. Now, the next question is simple. Where should your first $100 actually go? This is where many beginners get stuck. They open an investing app and see thousands of choices: stocks, ETFs, mutual funds, cryptocurrencies, bonds. It feels overwhelming. So they close the app and promise they'll figure it out later. But later often turns into months. The good news is this. Your first investment doesn't have to be complicated. Keeping it simple is usually the smartest choice. Think about building a house. You don't start by decorating the living room. You start with a strong foundation. Investing works the same way. Instead of trying to find the next big company, many experienced investors prefer owning hundreds of companies at once. Why? Because nobody knows which company will become the biggest winner over the next 20 years. That's why diversification matters. Imagine putting your entire $100 into one company. If it succeeds, that's great. But if it struggles, your investment could lose much of its value. Now imagine spreading that same money across hundreds of businesses. Some companies will grow, some will slow down, a few may even disappear, but together, they have a much better chance of growing steadily over time. That's why diversified index funds have become a favorite choice for long-term investors. They're simple, low-cost code, and they remove the pressure of trying to predict tomorrow's winners. Here's something interesting. Most people think successful investing means constantly buying and selling, checking prices every hour, watching financial news all day, reacting to every headline. In reality, many successful investors do the opposite. They make a plan, invest regularly, then leave their investments alone. It sounds boring, but boring often works surprisingly well. Now let's talk about another mistake, trying to time the market. People wait for prices to fall. Instead, the market rises. They wait again. Months pass. Nothing gets invested. Eventually, they buy because they're afraid of missing out. The truth is, Nobody consistently knows what the market will do next week or next month. That's why waiting for the perfect moment usually creates more stress than results. A better strategy is to invest consistently, whether markets are rising, falling, or moving sideways. Over time, consistency often beats perfect timing. Let's talk about another common mistake: trying to get rich too quickly. The internet is full of stories about overnight success. What you rarely hear are the thousands of people who lost money chasing the same dream. Building wealth usually isn't exciting. It's repetitive. Save, invest, repeat. Month after month, year after year. That's how wealth is built. Imagine two investors. The first constantly chases new opportunities, buying one stock, selling another, following every new trend. The second follows a simple routine. Every month, they invest a fixed amount into a diversified portfolio. Then, they go back to living their life. 10 years later, who has less stress? Who made fewer emotional decisions? Quite often, it's the second investor, because they trusted the process instead of trying to predict the future. Here's another habit that separates successful investors. They don't invest money they'll need next month. Investing is for the future. The longer your money stays invested, the more opportunity it has to grow. Patience becomes one of your greatest advantages. Now let's discuss automation. Most people say, I'll invest whenever I have extra money, but there's almost never any extra money left. Successful investors do the opposite. They invest first, then spend what's left. This doesn't mean ignoring your bills. It means treating investing like any other important monthly payment. You wouldn't forget your electricity bill. Your future deserves the same attention. That's why automatic investing is so powerful. It removes emotion. It builds consistency. And over time, those small, regular investments can grow into something far greater than most people expect. Your first $100 isn't about getting rich overnight. It's about building a habit that can last a lifetime. Start small. Stay consistent. Keep learning. Let time do the heavy lifting. Years from now, you probably won't remember the exact day you invested your first $100, but you'll be glad you did.